Let's deep dive. Nigerian equities took a deep dive last month as yields on debt papers trended higher. The central bank holds policy rates and inflation showed a tepid finishing line in the previous month of April. But if you are the increase in rates and deadliness of criminal enterprise and other violent acts or incidences across the country, there's every reason for investors to remain jittery more than ever before. Johnson Chukwu, the CEO at Cowry Asset Management, joins me now to trade the news tonight. Great to have you here on the show.
Thank you, Bosse, for having me.
Well, thank you very much. We appreciate your time. Let's start this very gentle note. What were the highlights of the financial markets last month?
To start with, we saw a market that suffered some level of liquidity decline, which affected different segments of the market. Starting from the Nigerian interbank true treasury yield, which increased in yield across all tenor buckets to as high as 9.6% from 8.8% for the 12 months yield. And then we saw that tightness of liquidity manifest in the volume, value, and number of deals in the equities market. We saw all three parameters, volume, value, and number of deals decline in the month of May. But interestingly, on the positive side, we saw that CBN, the discount rate on 364-day bills moderated from 9.95% to 9.65%, a gain of about 10 basis points. So we saw, though you saw a tightness in liquidity, and which led to an increase in yield across all tenor buckets, including long-dated instruments like the 2049 that had the yield increased to about 14.12%. So on the one side, you saw the tightened liquidity in the money market space or in the system led to increase in all yields. But on the other side, we saw that the central bank also signposted a moderation in the increase in treasury bill yields by coming up with a discount rate of 9.65%. If you observe, we've seen consistent increase in treasury bills yield in previous primary market auctions. But the last auction had a moderation in yield, particularly for the 364-day instruments. So you could say two things. One, tight liquidity in the system affected the equities market, value of transactions, volume of transactions. Market index lost about 3.5% in the month of May. Then it's also affected the pricing and the yield on the fixed income instruments. We saw prices go down and yields go up on fixed income instruments.
Okay, so but are there other significant developments that investors should take note of?
Yes, one of the things investors should be conscious of that there seems to be some improvement in the macroeconomic environment or macroeconomic indicators. We saw inflation rate moderated in the month of the April inflation rate moderated. We saw inflation rate drop from about 18.17% to 18.12%. We also saw food inflation improve from about 22.95% to about 22.75%. Then on the other side, secondly, we also saw that GDP growth rate accelerated in the first quarter of this year from the last quarter of 2020 growth rate of 0.11% to 0.51%. These are indicators that if the trend continues, you could actually say that the economy is improving. And if you even look at the Purchasing Managers Index, we also saw an improvement in Purchasing Managers Index, which could mean that there's more optimism among manufacturers that the outlook of the economy is improving.
Well, that's outlook, by the way. So let's throw exchange rate and inflation into that right now. Inflation was a little bit sticky, but still on the high side for the month of April. But then here we are now, right now, stepping into the month of June with exchange rate about 500 naira on the street to the US dollar. So what's your take on that? What should be the investors' playbook for under these circumstances on the equity side?
Well, on the equity side, what I would say investors should look at are instruments that give regular returns in form of cash dividend payment. Remember, at periods where you have high inflation rate, what you need, cash becomes king. That's when the concept of time value of money becomes very critical, because the money you get today has much more value than the money you get in longer periods. So for investors, retail investors, they should look out for equity instruments that pay interim dividend and are very aggressive, that pay aggressive dividend, have an aggressive dividend policy, so that they can actually cash out the returns on their investment at the shorter time than keeping them for a long time, because the value of money today will be much higher than the value of money in future. The time value of money, like I said, becomes very critical at a period when you have high inflation rates.
But
so remain in the short end of the market.
Are investors complaining right now about exchange rate inflation on their returns? Are they telling you that when you have this conversation with them? What are they talking about?
Yes, yes, certainly. Investors are knowledgeable enough, particularly institutional investors are knowledgeable enough to recognize that, look, the depreciation of the currency has a negative impact on the value of their wealth. So they are doing everything to insulate themselves from that. And you will see that some investors have actually migrated to Eurobond instruments so as to moderate the loss of value as a result of depreciation of the currency and inflation rate. So the fact is this, but for retail investors, they may not have the large ticket investment capacity to take on instruments like Eurobonds. And that's why I say for such investors, they remain in the short end of the market. They look for cash investments or investment that will give them cash returns. But clearly, there is no way your local currency instrument will not be affected by exchange rates and inflation rates. And those are eroding the values of the wealth of Nigerians that are holding those wealth in local currency instruments.
A quick one. So would the new FMDQ Securities Exchange weekly comprehensive FX report, would that be of any use to investors out there?
It brings a lot more transparency into the FX market. It allows investors to see the trend in market activities in terms of the yield and market offers for the different future time buckets. It also allows investors to see movement in IE window rates. And you also see the volume of trades that are executed. And this level of transparency is supposed to engender more confidence in the market, in the FS market, and reduce the flight to safety that we're witnessing.
Okay, let's talk more about this when we return. We have a whole lot to chew. Of course, Johnson Chukwu, CEO at Cowry Asset Management. Let's return to you after the break. Stand by, everyone. We'll be right back. You're welcome back to the show. So the Nigerian financial markets have been buffeted by the broader macroeconomic challenges of recent times, which includes 2 economic recessions and a pandemic holding turf at one of the key government agencies. The central bank is Godwin Emefiele, who clocks exactly 7 years in office today. Let's get Johnson Chukwu's first word on this. Johnson Chukwu, CEO at Cowry Asset Management, thank you very much. Give me your first word on this day of the 7th anniversary of central banking in a tight macroeconomic under Godwin Emefiele.
Well, what I would say is that the governor has done a lot to support the economy beyond even the calling of his role as a central bank governor. We've seen situations where the 2 times we went into recession, intervention from the monetary authorities were the factor that actually pulled out as a recession. And if you look at what the governor has done in the past 1 year, I would imagine that the economy would have been in a very difficult situation without those intervention funds. I can read out 1,001 of those funds. You have the 1 trillion naira intervention for the fund for the manufacturing sector. You had the 100 billion naira for the healthcare sector. You have the commercial agricultural credit scheme. You have the anchor borrowers program. You have the refinancing, sector refinancing facility. Both you can name all of them. But the fact is that the economy has remained alive today, principally not because of the fiscal authorities, but because of the interventions of the monetary authorities.
Okay, so here we are today, exchange rate, look at the money and the markets, looking at the monetary policies over the last 7 years, 2 recessions and a pandemic. Doesn't look like an easy time to be a very auspicious time to be a central banker.
Yes, clearly. In fact, I don't envy the work or the job of the current central bank governor. I mean, he has actually witnessed what you may call 2 world wars in terms of economic management. You mentioned the 2 recessions, 2016 and 2020. And like I said, he, to his credit, largely engineered Nigeria coming out of those recessions. All the interventions, go and look at the records, all the interventions we've seen, that including those that should have come from the fiscal authorities, are coming into the economy as some of the loan finance initiatives of the monetary authorities. So without those interventions, of course, we know the constraints of the fiscal authorities. Their revenues are quite weak. Last year, the year of pandemic, the total federal government revenue was just barely 3.5 trillion naira, when it spent 3.1 trillion naira to service debt. So you can actually understand the constraints. So without the intervention of the monetary authorities, it would have been a difficult thing for the country to have come out of the recession, to have had a recession that was a V-shaped, where we went in and came out so quickly.
Okay, so here we have our exchange rate right now. What's your take on how the exchange rate has been managed over the last 7 years?
What I would say is that managing the exchange rate in Nigeria is a very complex issue, and people tend to discuss the exchange rate without looking at the entire structure of the economy. Nigeria's foreign exchange earning is coming from one source, or largely one source, which is crude oil sales, which accounts for about 90% of the funds that we receive in terms of foreign exchange earnings. Those funds go straight to the central bank. So that means central bank, the market maker in managing FX. So you don't have multiplicity of foreign exchange earning sources, that you can have multiple institutions earning and selling FX, so you can have a perfect market environment. We don't have that in the country. So given the structure of foreign exchange earnings, we have to live with the fact that the central bank will remain in the short term to medium term the major market maker in FX management. So that also means that if you have a market maker where you have a single supplier or few suppliers and multiple buyers, you have to design a system that will allow for fair distribution of those sales. And those are the constants we have had to deal with. And remember that in the past 6 years, we've had, like you say, we have had 2 recessions. We have had 2 oil price collapses in 2016, in 2020, which led to severe drain on our foreign exchange earnings. Look at last year, sometime in February or thereabout, oil was trading at negative price. And we've seen in the recent past, our balance of trade has turned negative, principally because our foreign exchange earnings from our export had come below our foreign exchange payment from import. So the central bank has to find ways to manage the foreign exchange demand, which have a stripped supply. And certainly they have to come up with some creative models that will ensure we don't run out of reserve. So I'm not standing in for the central bank, but I am saying we have to face the reality of our economy, and that reality is that we don't have multiple foreign exchange earning sources like you have in other countries like Europe, where you have multiple, so the monies don't have to go to central bank for them to disburse or distribute to the end users.
So it boils down to the structure of the economy.
Absolutely.
Let's talk about something very important. Are we seeing the impact of increasing national insecurity environment already on our market straight?
Sure. The data from Nigerian Bureau of Statistics are really pointing to that. If you look at the Q1 GDP figure, you observe that agriculture, which accounts for about 22.35% of the GDP, growth rate declined from about 3.41% to about 2.28%. So that could be a manifestation of insecurity in the country because farmers have been displaced. And that also takes us back to what we're discussing. Managing the economy where there's physical weaknesses is actually a difficult thing for the monetary authorities because the monetary authorities is not the one to fight insecurity. They're not the ones to ensure that farmers remain in their farms to produce so that you have high level of productivity that will lead to moderation in inflation rate, that will lead to higher growth in economic activities or GDP growth that will lead to higher level of employment. Some of these things are limitations that the monetary authorities have to face in terms of monetary effectiveness, monetary policy effectiveness. But the reality is that when you have the level of insecurity we have today, it's manifesting in food production, it's manifesting in food inflation. Food inflation in the month of April was 22.72%, though a moderation from 22.95%, but 22.72% is still quite high for an economy whose consumption are largely homegrown goods. If you look at even the food inflation figures, you realize that the factors that are driving up the food items that are driving up food inflation are basically cereals, tubers. These are things that are not normally produced locally. They're not imported items. So clearly, the insecurity is affecting food production, it's affecting GDP growth rate, it's affecting food inflation rate, and it's leading to high level of unemployment.
So what about the broad street where you have the financial markets? That's my question. Are we seeing the impact already? Are investors, local investors, really concerned right now, like they were before, about what you call the insecurity risk? We used to talk about political risk of a country. Here we are right now. Insecurity seems to have sneaked its way onto that list of risks that you consider.
Yeah, the truth is that there's no way you make an investment you won't consider the sovereign risk of where you are, including your local sovereign risk. And as we stand today, that has heightened, which also could explain why in the month of May we saw volume of transactions decline, we saw value of transactions decline, we saw the number of deals decline compared to the figures we had in April. Again, I've also said that beyond that, you also recognize that foreign investors are also major market players in the capital market. So when you have heightened level of unemployment, the foreign investors are the first to stay back, and local investors will now stay in the short end of the market because at such periods of uncertainty, cash is king. So you don't want to invest in an asset you cannot liquefy quickly in case the situation deteriorates. We don't pray it deteriorates, but clearly when you have the level of insecurity we have in the country, nobody wants to play long. People are buying short-term instruments. People are investing in near cash instruments so that they are not stuck in case they need liquidity urgently.
What's your outlook for the rest of the year under this scenario, Johnson?
The first thing I would say is that the outlook or anybody's prediction will be predicated on how the government is able to manage the insecurity situation in the country. I'm hoping that we've gotten to a turning point where the government will take appropriate measures to turn around the deteriorating state of the insecurity in the country. Once that is done, I had already mentioned earlier that we have seen some green shoots in terms of macroeconomic indicators. We saw increase in GDP growth rate, though still very fragile at 0.51%. We saw a moderation in inflation rate, but all these things can only be sustained if we get a hang on the level of insecurity in the country.
Thank you so much, Johnson Chukwu, CEO at Cowry Asset Management. See you next time. Have a great evening.